then in this sort of a market, where should you invest given the fact that now the budget is out? There are a lot of themes that are looking much more brighter and something that you should watch out for. So let's ask the question to Prashant Khemka, who's a founder at White Oak Capital Management. Very good morning, good afternoon to you, Mr. Khemka. Thank you so much for joining us in ET Now. And the big question here now is that do you think that it is the time to go ahead and park your money in the consumption theme and say goodbye to the Capex theme?
Good afternoon, Cheryl. So I think, look, last several years there was a strong operating momentum, and as a result of that, uh, there were multiple expansion in the domestic cyclicals. Yeah, and the consumption, it was the other way around. Consumption stocks, they were suffering from somewhat weaker operating environment. As we all know, last couple of years the consumption names have reported somewhat subdued numbers, and they've gone through uh, multiple compression. One can argue they started with lot higher multiples than historical averages, and the cyclical started with a lot lower multiples, and so there's been some mean reversion. And beyond mean reversion, I think the cyclicals, extrapolated the strength for much longer. So there is this last, I think, since budget, not since budget, since election, central election, there has been this underlying churn, if you will, going on in the performance of cyclicals versus the defensives or consumption stocks. So this budget, I think, is only going to reinforce potentially that phenomenon. It's not any substantial degree of underperformance of any particular sector that we are expecting, but that one way outperformance of the cyclicals compared to the defensives or the consumption basket, that may not be there going forward to the extent at least that we saw over the last many years.
Absolutely. Prashant Pal, the good gains, or rather the good times or best times, may be behind us, at least for the near term. But what would your advice be out there? One can't completely switch off from the Capex theme, right? Because the budget did have a fair allocation towards Capex. I mean, yes, the valuation comfort is more within FMCG, staples, and some of the consumer names. But, so in that sense, higher alpha generation. But Capex is something that you got to have in your core portfolio.
No, absolutely, Aisha. And just so as to be not miscommunicating what we're thinking, we don't take these top-down calls. We don't think money can be made in taking top-down calls. So we never, you know, went gung-ho on these capital expenditure names. Maybe we should have, but we never do that. And never did we exit the consumption or the more defensive-oriented, consumer-oriented or other defensive segments of the market. So our perspective is always have a balanced portfolio. There are great opportunities to find in every segment of the market, in every sector of the market, and every other way you slice and dice the market, you can find good investment opportunities. So even now, we are not at all advocating, or not do our portfolios have any such strong bias in one direction or the other. Yeah, mild differences are there. We always tend to be higher allocated in areas like technology, financials, particularly private sector financials, healthcare, and consumption. And we continue to, over the last 5 years, that's been true. Even today, that's been true. Over the last couple of years, that tilt might have hurt us some. And over the last few months, or since the central election last year, maybe that tilt has helped us some. But we are talking about on the margin, these tilts, not extreme positions, Aisha.
Prashant, while
Because the
there's no...
true alpha, true
Yeah.
performance is generated through stock picking.
Absolutely, absolutely. But Prashant, the impact of income tax savings on demand can be quite meaningful, right? There is no taking away from that. You just talked about consumption. Tell me, where within the large consumption pool would you pick stocks if you had to pick afresh? Because when it comes to staples, they're price inelastic. Someone's not going to consume more shampoos. They may, sort of upgrade, but they're not going to use more shampoo or salt just because, they've got some more money in their hands. Do you think that the consumption, or rather the way to consumption, is now to play through once again the premiumization theme? Would it be through hospitality? Would it be through aviation, or these kind of spaces, branded apparel and retail?
So see, first of all, it's not that it is new news altogether to for these stocks, yeah. And uh, post the election outcome itself, there was a, as I was saying, outperformance that began, and even the budget last year in July had started in this direction. So it is not a sudden discovery. Yes, this tax benefit is somewhat higher. Now, these stocks have also yesterday and today, or Saturday and today, outperformed by a few percentage points. So you have to keep in mind that this 1 lakh crore is also a finite amount. Yeah. And how much of that is going to end up benefiting companies that are listed? If someone who's earning, say, 12 lakh rupees, if they get an extra, whatever, 75, 80,000 rupees, they're not going to spend it all. They may save a portion of that. A good part of it may go into saving. Hopefully, a good part of it, the largest chunk, would go into mutual fund savings, yeah, investments. So there would be beneficiaries of that in multiple sectors. You can't just, I think, narrow down to just consumer stocks. Yes, there would be anything that this bracket of um um, earners, when they have more money in the pocket that they would spend on, they will all get some benefit. It's not to be magnified beyond what the reality could be. But yes, there'll be variety of this. Consumer durables would be one segment as well, because there'll be more discretionary money to spend, and there'll be more savings as well. So I think financial services companies also would stand to benefit. But again, Aisha, to my point, I don't think money can be made by now chasing at this point where we are today on Monday afternoon, chasing sectoral themes that would benefit from that 1 lakh crore additional span.
Right, rightly said, actually. So let me move on from that. And you did speak about tech, financials, healthcare, some of the segments that you actually like. Given the fact that you have a new regime, and after we spoke to you last, now we actually have the new regime at helm. When you talk about the United States, the Trump administration, definitely he's gone ahead with the tariff announcements on Canada, Mexico, and China for now. But in that light, and if you take the larger scheme of things, how do you like, or rather, what are your thesis now for the IT sector, given the fact that now you're seeing dollar denomination also, domination, I mean?
Absolutely. So if you see in all this commentary, and when I last spoke to Nikunj and you all, I was talking about two major events having taken place in November. One was the Trump re-election, and the other was the state election outcomes. Um, and if you think of the Trump re-election, he's following through all his, or a lot of his promises. So he has imposed already tariffs on several countries. Yeah, he's never talked about India. I mean, obviously, he's mentioned India being tariff king and all that, but in case of India, it's just too small. If you look at the list of countries that US imports from, India is fairly down, far smaller to matter compared to the countries Canada, Mexico, China are amongst the top five, and EU is the other major partner. So I think we would stand to benefit from these. I was just now meeting with a company who is into, related to manufacturing of, let's say, toys. So they put, US has imposed 10% additional duty on everything China. China constitutes 60% of the global, 60 plus percent of the global toy trade. India is less than 1%. Yeah. So China is like 100 times in the global toy trade than India is. Now, China has become 10% more expensive, one. And in the budget, the government has talked about uh, giving special impetus to the toy industry. It could come through a PLI, it could come through some other support, but let's assume that's another 10%. So 10 plus 10, that's 20%. And for US companies, let's say, it's not the only thing that they have to, this 20% is not the only thing that they have to consider. They have to worry about what future restrictions could come on sourcing from China, and hence have to diversify risk beyond just monetary considerations, immediate monetary considerations. They have to also diversify risk of sourcing from China. So that is also further going to benefit a place like India from expansion or diversification of manufacturing. So I do see the announcements that Trump has made is a relative positive for India. And that's along the lines of what we were talking about last time, that Trump may be negative for humanity in some people's view, may be negative for some other countries, emerging market countries, developed market countries. But I do think on a relative basis, the actions that he's promised should be positive for India. The IT sector, technology sector, so far I haven't heard anything, materially negative that he intends to do. They want to strengthen US's technology lead against China and other countries. India provides that horsepower. Indian IT professionals, they provide that horsepower to American companies to maintain their lead. So I highly doubt they'll do something that is self-defeating under Trump.
Oh, yeah, absolutely. But Prashant, is that enough for FIIs to come back to India? I wonder what queue are they looking for?
See, right now everyone is rushing back to US or increasing their investment in the US. They are taking money, and US is 70% of global equity market. So it's not like, if the equity market is 5% of the global equity market, you may add 1% to that 5%, yeah, and it becomes 20% higher weight than its weight in the benchmark. When it is 70% weight of the global benchmark, you'll tend to move in larger chunks. So if you have to add weight to, let's say, 5 percentage weight to US collectively, I don't think it would be that large, but I'm just saying, if you add even 2% weight from 70 to 72, or someone going from 65 to 67, a lot of people have been underweight US. They've been overweight emerging markets for the longest of time periods because of faster growth expectations in emerging markets and whatnot. Now there is a clear shift or readjustment happening, where I see a lot of clients reducing the weight of emerging markets. And if they make a 2% shift from rest of equities to the US, going from 68 to 70 or 70 to 72, so it all has to come from that remaining 30% bucket. And if emerging markets is of that 30 is 10, it would also come from that 10. Yeah. So 30, if it were to give 2, that means a 7% reduction in the total allocation to emerging markets in global portfolios. That's a part of that is what we are seeing over the last 2 3 months. Money moving out of emerging markets going into, before, in September October, it was money moving to China. It just so happened, unfortunately, that these two events happened back to back. September October was money moving from other EMs to China because the sharp 35% rally. And now in November, December, January, what we are seeing is money moving from everywhere, including emerging markets, to the US. Impossible to say when it slows down and when it stops, but it would. Yeah. And then you'll have again the normal inflows and outflows both sides. Right now, what we are seeing day after day after day is only outflows because of this massive wave of money moving out from everywhere else to move to US.
But Prashant, do you see that bubble burst at some point, or will it continue to be US's favorite kind of slogan?
Well, I won't say it's a bubble, because if you look at the valuations in the US, yes, they may be a tad above longer term ranges, but nowhere near extremes. If if Trump delivers on all that he's saying, it could be, good for corporate earnings in the US. And that's what the market, I think, last year anticipated. That's why last year the US markets rallied quite substantially, just like Indian markets rallied in 2000, ahead of the May 2014 election results, anticipating a win for Modi. I think the markets in US were anticipating a win for Trump and had a good rally. So I don't see that bubble kind of situation, at least as of now, in neither in India nor in the US. I think it can just this money flow would settle somewhere. It can't go on for very extended periods of time. The month year end is a natural time period. Yeah. So December and January are very natural time periods globally for asset allocators to reallocate their exposures. And hence, around in January in particular, you do see this shift related outflows, which are much larger in quantum. So I think we should see this taper down over the coming days.
Everyone is waiting for that pretty eagerly. Thank you so much, Mr. Khemka, for joining us on the show to talk about the markets and what sort of a strategy one should adopt when you talk about Indian investing, given the fact that you had the big bumper budget coming out. And yes, everybody is pretty gung-ho on the consumption space as of now when they look at it on the surface. Thank you so much for being part of the show.
Thank you, Cheryl. Thank you, Aisha.
If you like this video, then like, share and subscribe to ET Now.